The money that made a nation suddenly turned on the people who trusted it. Why did a young republic, flush with land and optimism, slide so fast from euphoria to foreclosure? Why did a bank that helped build America survive, while tens of thousands lost their farms, their stores, and in some cities, their freedom? Keep listening. The answer lives in ledgers, in ship manifests, and in a single collapsing commodity that linked a farmer in Georgia to a broker in Liverpool. Picture the United States in 1815 to 1818, a nation emerging from war, a market suddenly open to the world, a frontier yawning west. The federal government sold public land at $2 an acre on credit and accepted paper notes for payment. That credit binge swelled public land debt from roughly $3 million in 1815 to about $17 million by 1818, and it turned acres into mortgages the moment prices stopped rising. This was not abstract risk. It was a paper claim on a farmer's livelihood. Credit flowed like newly melted silver. State banks multiplied, printing notes and making loans to speculators who bought cheap land and resold it at higher prices. The Second Bank of the United States, created in 1816 to stabilize that system, had a fragile heart. By mid-1818, its branches faced demand liabilities many times larger than the specie in its vaults. In plain numbers, the bank was carrying demand liabilities measured in the tens of millions, while its hard money reserves were a few million at best. That mismatch left it with a choice: keep printing and hope, or pull in credit to defend its reserves. It chose the latter. You can feel the moment. A merchant in Philadelphia counts notes under a dim lamp, the paper warm with ink and the last suds of optimism. A planter in Alabama signs a mortgage for new land, while a ship-ass manifest lists cotton, bound for Liverpool. Then a single market signal snaps. Cotton prices, America's export pulse, collapsed. By late 1819, cotton prices had fallen sharply, at times by half from their wartime highs, and a single day in January had seen a dramatic fall that spread panic through ports and towns. When the commodity that underpinned so much credit lost value, the math behind every loan changed overnight. Credit contraction is never clean. The Second Bank began to demand specie and to call in loans from state banks that could not redeem themselves in gold or silver. State banks, unable to meet those calls, stopped redeeming notes and then began foreclosing on mortgages they could no longer carry on their books. Whole communities felt the sound of ledger books closing. The bank's actions were defensible on the balance sheet and ruinous on Main Street. As one contemporary put it, and a phrase that would echo for decades, the bank was saved and the people were ruined. That line was not a slogan. It was the humiliation of thousands who watched their farms pass into bank ownership. How does a credit boom become a depression? Start with faith. Paper banknotes only work when people believe they can be converted to specie or spent without loss. When too many notes are issued for too little specie, prices rise and a speculative economy grows in size and fragility. When the central actor, the national bank, stops extending credit to preserve its reserves, the fragile structure collapses, price levels fall, debt burdens rise in real terms, and the weakest actors are wiped out. That mechanism played out across the Ohio Valley, through Kentucky, Tennessee, and into the Deep South. Visual foreclosure notices nailed to courthouse doors. At the human scale, there are small, sharp stories. I want you to see Mary, a hypothetical Midwestern widow, lending her name on a half-section of land, because local credit told a better story than cash ever could. Her buyer is a speculator who owes other debts. When cotton prices tumble and the speculator cannot roll his loans, Mary's title becomes a problem for local lawyers and a profit center for bank clerks. She might be jailed for debt in Philadelphia, while whiskey and grain change hands as a crude form of money elsewhere. The crisis was as personal as it was technical. Yet this was not a single villain story. The second bank had itself been lax in earlier years. Its branches had pumped notes into the West, while also accepting state banknotes as payment for federal lands. The bank helped build the boom and then tried to live through the bust. Its president resigned in 1819 amid scandal, and the new leadership tightened credit hard and fast. That tightening stabilized the bank's books, but deepened the public's losses, and it fed a political fury that would reshape American finance. What followed was not just economic pain. Politics turned ferocious. Farmers and debtors demanded relief and blamed banks for creating and then starving credit. Populist anger found language and leaders. Land debtor relief acts, state moratoria, and public meetings filled with jeering rhetoric became part of a broader movement that would help make Andrew Jackson's distrust of centralized banking into a national crusade. The Panic of 1819 was the seedbed of the bank wars to come. Pause here. If this makes you look at your bank balance differently, hit subscribe, and we will keep pulling these threads. The long tail of the panic reveals patterns that repeat. When a major sector is heavily leveraged on a single commodity or asset class, and when credit expands faster than reserves can back it, an external price shock will force a painful revaluation. Think of 1819's land and cotton, then think across 2 centuries. The housing boom and bust of 2007 to 2009 was similarly built on easy credit and asset-backed paper that suddenly could not be redeemed on expected terms. The actors change. Planters became homeowners, cotton became mortgages, but the logic, too much credit, too little hard backing, panic when prices reverse, remains the same. Ask the question the bankers asked then: should a central bank save itself, even if the cure kills large parts of the economy? The early republic answered in 2 ways at once. Legally and technically, the second bank was rescued. Institutionally, it survived. Politically and socially, the crisis reshaped trust. Hard money advocates preached specie and simplicity. The bank monster rhetoric grew into policy debates that would change America, yes, banking architecture for decades. What are the 3 things to take away from this story? First, credit is a social contract, and its breakdown hits people first, even if institutions survive. Second, a single drop in the market for a major export or asset can convert friendly debt into crushing obligation. Third, political reactions to financial pain can be as consequential as the financial crisis itself, sometimes leading to structural reforms that last generations. So what should a citizen take from 1819? Watch the composition of credit, not just its size. Ask who holds the hard reserves and who holds the paper. Look for concentrations of risk in a single commodity or region. Those are the places where a modern panic will begin. There is a moral here, but not a sermon. Financial systems are human inventions, and human beings bend them toward bold projects and toward greed. The Panic of 1819 shows how a nation's appetite for land, credit, and growth can outrun the institutions meant to hold it together, and how the remedy can wound as badly as the illness. History ends with a ledger. The next line in that ledger is always being written. The rest of this story is waiting in the ledgers. If this shifted how you see money and power, Join us. Tell us which part of this episode surprised you most. And if you want more deep dives like this, subscribe and keep searching the threads they rarely teach in school.